Hello friends, here in this session we will discuss the Indian financial system. So what is the Indian financial system? We will have an overview here. Okay. So first, what do you mean by the financial system? First we will understand what is the financial system. See, the financial system is a structure in an economy to mobilize the capital from various surplus sectors of the economy and allocate it and distribute them to the various needy sectors. Means what is basically the financial system? Financial system means what? We are having different sectors, right? For ease of understanding, we are having a manufacturing sector, we are having IT sector, we are having agriculture sector, right? So in case of a financial system, what we do, we know the agri is our it is not that much of good as compared to the IT. So whatever the surplus revenue we generate from IT, we will utilize it for boost in the agriculture sector. That is basically the financial system. Okay. Now what are, see, you don't need to remember this definition, you have to just understand. See, in case of a JAIIB, you have to understand, you have to first only understand the concept, what things you need to remember. You should mug up that, I will tell you time to time. Okay. But here you don't need to mug up the definitions, you just understand. Financial system means simply we are having different systems, we will use money from one system in the other system, or money from one sector we can utilize it for the other sector using the financial system. Now what are the financial system compromise of? See, as a your banker, you are very much familiar with the financial system. See, for example, see, your bank, you are working in a bank, right? Your bank is having head office, then after that your bank is having different zonal offices, right? Then each zonal office will have different regional offices, right? And each regional offices have some branches. So this is basically the system. And then there are different banks, this one bank, then other banks, these all bank work under the RBI. So this is the banking system, right? So here we will talk about the financial system. So what is the financial system compromise of? See, financial system, obviously the Ministry of Finance and Government of India, a regulatory institution, these are the apex in the financial system. Okay, so what do you mean by financial system? And it constitutes of, financial system consists of Ministry of Finance, RBI. RBI, you know, RBI is the central banking authority or the regulator in the banking. Now SEBI is the capital market regulator. Then IRDA is the insurance regulatory. PFRDA is the pension fund regulatory. NABARD, NHB is the National Housing Board. These are the supervisory, they play the supervisory role. So basically, first understand here what are the components of the, or what are the constituents of the financial system. We are having RBI, SEBI, IRDA, PFRDA, NABARD, NHB, IBBI means Insolvency and Bankruptcy Board of India. Okay, now see here how the question will be there. See, you are very much familiar, RBI is the central banking authority or central bank to India. Okay, so you will not get that question, but they may ask you a question, which of the following is the capital market regulatory? What is the capital market? Whatever you purchase the shares, debentures, right, different stocks of the company, right, mutual fund, these are regulated by whom? These are regulated by the SEBI, that is Security Exchange Board of India. Okay, so remember, capital market regulator is SEBI, insurance market regulator is whom? Is IRDA, insurance regulatory authority is IRDA, headquarter Hyderabad. You don't need to remember the headquarter, but you have to remember that who so most of the favorite question of IIBF is capital market regulator. So remember, it is a SEBI. Apart from that, we are having NABARD, we are having NHB. NHB is a National Housing Board, right? And recently we got the IBBC through the Insolvency and Bankruptcy Code. We got IBBI. IBBI stands for the Insolvency and Bankruptcy Board of India. Remember, this is also one of the important part of the financial system. Okay, so this is just overview. In this chapter we are going to take only the overview. Okay, subsequently we have to discuss in detail, right? So here next we will discuss what are the segment of the financial system. So financial system, we are having money market, we are having debt market, we are having forex market, and we are having capital market. Just we have discussed what is capital market regulator. It is a SEBI. SEBI is the capital market regulator. Who is the then forex, then money market, then debt market. Money market, what is the money market? Mainly RBI control the RBI is the monetary authority. Who is the monetary authority of a country? RBI is the monetary authority. RBI control and regulate the money market. Okay, so subsequently one by one we will discuss. Okay, what does it mean by money market? First, see, money market means what? It is a monetary system, or it is a part of system which involve lending and borrowing of a short-term fund. So what do you mean by that? See, where you can lend money. Money market is the market where you can lend money or you can borrow money. You can borrow money for a short duration. What do you mean by short duration? Generally less than 12 months. This is the market called as the money market. And 99% in case of a money market, we are having unsecured lending. The lending is unsecured, means no collateral is available, no guarantee is available. Now see, in that capital market, very one term is very famous, that is called as the call money. What do you mean by call money? See, call money means borrowing or lending in unsecured fund for the overnight basis. Generally means what? It is only for the one day. Okay, remember. Next, notice money. Notice money means what? If the borrowing or lending in the unsecured fund for the period of 2 to 14 days, it is called as the notice money. And term money means beyond 14 days and up to 1 year, it is called as the term money. So definitely you will get a question, what do you mean by call money? Generally lending for the one day overnight basis, it is called as the call money. Lending for 2 to 14 days, it is under the notice money, and lending for 14 days to 1 year, it is a part of the term money. Okay, so remember, what is a money market? Money market, we lend money for short duration. And what duration? For one day, it is call money. For 2 to 14 days lending or borrowing, it is called as the notice money. Or for 14 days to 1 year, it is called as the term money. So remember, for these they may ask you a question. Okay, now next is the T-bill. In a money market, we are having next is the T-bill. T-bill is nothing but the Treasury Bill. So what is a Treasury Bill? So friends, see, this is the bill that is also the form of short-term borrowing. And see, when government needs a fund, government will sell the T-bill. Government will sell the T-bill. For example, if a T-bill is for the period of a 91 day, the maturity is 91 day, and the price of the T-bill is 100 rupees. So government will say you buy it at only 90 rupees, and after 91 days I will give you 100 rupees. So the face value is 100 rupees is written on that bond, and government is selling that T-bill through the RBI, and government will say that the price of bond is 100 rupees, but I am offering it at a discount of 90 rupees, and after maturity, there is a 91 days, you will get 100 rupees. That is the concept of the T-bill. Okay, now here the maturity period of the T-bill, that is a Treasury bill, varies. It varies from 91 days, then just multiply twice, that is 182 days, and twice of that, it is 364 days. So you may get a question, which of the following is not a valid maturity period of the T-bill? So remember, T-bill we are having 91 days, 182 days, or 364 days. Okay, so this is the T-bill maturity. Okay, so when government need a fund, government will go for the T-bills. Okay, now this is also the money market instrument. Now what we are to discuss is the certificate of a deposit. So what is a certificate of deposit? See, banks means what? It may be a scheduled commercial bank, it may be RRB, that is a regional rural bank, or the small finance bank, or the payment bank, and these are eligible to issue the certificate of deposit. Remember, you may get a question one liner that here they will ask you that whether the local area bank are eligible for the to issue the certificate of deposit or not. So remember, local area banks are not allowed to issue the certificate of deposit. Okay, that line you have to remember. Now, what is the period for the certificate of deposit? See, period varies from 7 days to 1 year. Okay, and to the some financial institution, that is selected financial institution, it may grant it up to 3 years. Okay, so general period for the certificate of deposit, which you should remember, is 7 days to 1 year, but for some financial institution it is allowed that they can have a 1 to 3 year certificate of deposit. Now, what is amount that can be put in the certificate of deposit? So amount for the certificate of deposit is rupees 5 lakh and multiple of a 5 lakh. Okay, so these can be MCQ, which you have to remember. After that, the no loan against the certificate of deposit can be given. So banks are not allowed to give any loan against the certificate of deposit. And remember, here buyback allowed, but only after 7 days. Why? Because minimum period is 7 days. So buyback is only allowed after 7 days. Okay, so this is just you have to remember some bits about the certificate of deposit. See, certificate of deposit is the money market instrument. Okay, and remember, in the certificate of deposit, for that local area banks are not eligible. The general period is 7 days to 1 year, and amount is 5 lakh and multiple, means 5, 10, 15, 20 and multiple of that, no limit. Okay, but it should be multiple of a 5. Okay, so and you cannot sanction the loan against the certificate of deposit. So these are the bits you have to remember about certificate of deposit. Now, next instrument we should discuss, and it is the commercial paper. That is, in short, it is called as the CP, commercial paper, CP. So see, if any company, I will say here Tata, they want money, and like if government want money, government what issue? Government will issue the bond. Government will issue the SGB, sovereign gold bond. Government will issue the T-bill. Okay, and they will sell that in the market. But if a private company, any company like Tata, they need money, then how can they raise a fund? For that, there is a provision that is called as the commercial paper. They will issue the commercial paper. The people will subscribe for it. Okay, and that money will get, the company will get a money. Okay, they will raise a fund. So in this way, the commercial paper is being used. Now see, commercial paper, it is unsecured companies, Nbfc and all India financial institution. Okay, so these can issue the commercial paper. Who can issue? Unsecured company, Nbfc and all India financial institution. Other entity with a minimum net worth of 100 crore. It may be the cooperative society, trust or LLP. They are also eligible to issue the commercial paper, provided that net worth should be minimum 100 crore. Now, the what question can be asked? It is most important and a frequently asked question is that what is the amount of a CP can be issued? CP can be issued in a 5 lakh and a multiple of a 5 lakh. That means 5 lakh, 10 lakh, 15 lakh, 20 lakh, 25 lakh and so on. Okay, it should be multiple of a 5 and a 5 lakh. Okay, so minimum amount of commercial paper, you should remember, it is 5 lakh and there is no maximum limit, and it should be in the multiple of a 5 lakh. Now, what is the maturity period of a commercial paper? It ranges from 7 days to 1 year. Sorry. Now, credit rating. When we talk about the credit rating, minimum A3, which is SEBI prescribed. Okay, SEBI has prescribed that the company which want to issue the commercial paper, it should have a A3 rating from SEBI. Okay, so credit rating is required. Minimum credit rating required is A3 for issuing the commercial paper. Okay, that also you can remember. And if you are going to issue for the total commercial paper having worth more than 1000 CR, then minimum 2 ratings are required. Buyback is allowed, but not before 30 days. Okay, so by the company, we see, for example, Tata has issued the commercial paper. Now Tata want to buy back that commercial paper, so buyback is also allowed, but that should be after 30 days of issuing. Okay, so remember, in case of a commercial, in case of the certificate of deposit, all things are same, only here buyback period is after 7 days, but in case of the commercial paper, buyback is after 30 days. Okay, so here the highlighted things are important, which you should remember. Okay, now next, what is the cash management bill? See, CMB, that is cash management bill, it has a generic character of a T bill, but are issued for a maturity less than 91 days. So just what we have discussed, T bill, that is the treasury bill. Government issue treasury bill, that is through the RBI, right? Central government needs money, then they will ask RBI, kindly issue the T bill, we want money. So RBI will issue it for 91 days, 182 days and 364 days. Okay, so this is the maturity period of what? T bill, which is fixed. But if the government want money which is less than, for the period of less than 91 days, then how they can, what they can do? They will go for the cash management bill. Okay, it is same as the T bill, but provided only difference in the T bill and the CMB is that it is having maturity less than 91 days. Okay, underline the thing in your mind, that maturity should be less than 91 days. All is same about the T bill. It is called as the cash management bill. Now, what is a CBLO? Sometimes they will ask you a full form of a CBLO, that is a collateralized borrowing and lending obligation. Now, for entity who have no access or the restricted access to interbank call money market, they will go for the CBLO. Now, we have discussed what? We have discussed the entities that can be called for the call money. It is for 1 day. They can borrow money for 1 day, or there may be a notice money which is for 2 to 14 days, or there may be a term money which is for 14 to days to 1 year. Okay, this is the call money, notice money, term money. But some entity which do not have access to that term money, call money, notice money, then they will go for the CBLO, that is a centralized borrowing and lending obligation. Now, they are the CBLO operation is being done through the INFI entity, that is a Indian Financial Network. INFI entity stands for Indian Financial Network, and the NDS, that is a negotiated dealing system. So you don't need to worry about what is it. It is basically the network. We are having different networks, right? So Indian Financial Network is one of the type of network which is being used for the financial transactions, and they are using the NDS, that is a negotiated dealing system. So sometimes they will ask you the full form of NDS. So NDS stands for negotiated dealing system. Okay, now in case of a CBLO, it is a collateralized, sorry, it is not a centralized, it is the collateralized borrowing and lending obligation. Now here, what you have to remember, that when you are, that is the bank is going to enter in the CBLO, the minimum amount should be a 50 lakh, and then it is a multiple of 5 lakh. Means if you want to enter for the CBLO, that is collateralized borrowing and lending obligation, you must enter for the initial transaction of a 50 lakh rupees. After that, you can go for the 55 lakh, 60 lakh, 65 lakh, 70 lakh and so on. Next, you can, it can be a multiple of 5, but a minimum amount is 5 lakh. Sorry, minimum amount is 50 lakh. Okay, so that is the bit you should remember. Normally, what is the time period? It ranges from 1 day to 90 days, but it can go up to 1 year. Like similarly, it is like a call money, notice money, term money. Those who cannot have access to the call money, notice money, term money, they can go for the CBLO, that is collateralized borrowing and lending obligation. Now, next full form you should remember is FIMMDA. FIMMDA. FIMM means Fixed Income Money Market Derivative Association of India. Okay, you just remember the full form. It is not necessary you should understand or should learn something. It is organization basically, right? So FIMMDA is Fixed Income Money Market Derivative Association of India. Fixed Income Money Market Derivative Association of India. Okay, that is FIMMDA. Remember the full form. Now, next market we are going to discuss is the debt market. So, what is the debt market basically? Debt market means simply it is the it is also called as the fixed income market. It is also called as the fixed income market. Now here, what is meant by fixed income market? Here, generally government raises fund. Government raise the fund, and in that return, government has to give some money interest charge to the who is buying that security. Okay, and that interest is fixed. That's what is called as the fixed income market or debt market. Best example, sovereign gold bond. You are all are in the banks. You might have gone through the gold bond scheme. So what is happening? The person will purchase the gold bonds, right? There is a, for example, say 5 gram. He has purchased. He will get just a paper that saying you have purchased a 5 gram gold. But whole money, whatever he has invested for purchasing that, will go to the government, and government can enjoy that money for different infrastructure projects or for the development projects. Okay, so this is basically how it works, right? How the government get money through the bonds, debentures, securities, right? Taxes. So here, what is a debt market? Simply it is a fixed income market. So through example you can easily come to know what is the debt market. See, when you talk about the government security, when you talk about the different bonds, when you talk about the sovereign gold bond, these are the debt market instruments. Now what is government security? Simply the security which are issued by the government, and obviously it will be risk free. It will be risk free, and it will be issued at a par value through the bid or the ask rate. For example, if government is going to issue a security, and that is issued at a par, generally value having 100 rupees, so it will be offered at 100 rupees. So the government will set a discount rate, right? For example, 6% minimum. So the person who is offering that should have a minimum 6%, he should ask for a bid for having discount minimum 6%. Okay, or above that, that will be accepted. So people will bid. For example, some people will ask for 94 rupees, some people will ask for 95, some will ask for 99. So the person who is going to ask for 94, the government will not sell, because 6 rupees government has to pay later on. So government will say, no, he has asked for 99, I have to pay only 1 rupees. Okay, as a income, or as a commission, or as a income. Okay, as a fixed income. So government will go for that, the person who has bidded for 99 rupees. Okay, so it is just for your understanding purpose. So that is basically the government security. Why? Because it is having less risk. It is 100%. See, in sovereign gold bond, there is any risk? No, there is no any risk, because government is issuing that, and government has backup. Okay, now that's why there is a zero risk. Now generally coupon rate, what is a coupon rate? You should understand here. It is we are going in deep here in the first chapter itself. First chapter is very much you have to do the only overview. Coupon rate is what? If you have purchased say bond for rupees 100, and it is mentioned that coupon rate is I will say 10% payable semi-annually. 10% semi-annually means you will get 5%, right? So 5% of 100 rupees means 5 rupees you are getting every 6 months. Okay, and that is nothing but the coupon rate. Okay, coupon rate here, don't get confused. Coupon means basically you are getting the interest. Okay, so what is the tenure? General tenure for the government security is 1 year to 30 years. And if it is a dated government security, it ranges from 5 to 30. You don't need to remember in that detail. Okay, for your understanding only, I have given in detail what is government security. Now see, central government, both a treasury bill and bonds dated securities can be issued by the central government. Now it is very important, you should note that central government can issue T-bill. Who issue the T-bill? Obviously it is issued by the RBI on behalf of the central government. And also bond or dated securities also issued by the central government only. Now the state government issue only bond or the dated security. So T-bills are not allowed to issued by the state government. So very important, you have to remember that central government is only allowed to issue the Treasury Bill. State governments are not allowed. Okay, state governments can issue only some bonds or the dated security, which are oftenly called as the SDL, that is a state development loan. So it is basically the loan you are purchasing that security or the bonds, so in that return government will get a money. So obviously it is the state development loans. Okay, very easy. Now here RBI act as the depository, means here if government want money, government will say to RBI issue the bill, so RBI will issue that. Okay, so RBI is working as a functionary here. So that is basically RBI act as a depository, means whatever the record is being handled by the RBI. Okay, that is called as the RBI is a depository. Now what is a bond? See, basically bond is issued by the corporate or the government. It may be issued by a government undertaking institutions. Period is as per the requirement of the institution. Okay, for how much long they require money. Rate of interest also, it may be fixed or it may be variable. Okay, so this is all about bond. You are very much familiar with about the bond. In that detail we will discuss the SGB, because they may ask a question based on SGB. So what is the sovereign gold bond? SGB means sovereign gold bond. So it is a bond which is issued by RBI and it is on behalf of the government of India. So where money will go? Money will go to the government of India. So what is the minimum? Minimum 1 gram should be you have to buy. If you are going to purchase, you have to purchase minimum 1 gram, and maximum is 4 kg you can buy per year, and individually and even for a HUF, that is a Hindu undivided family, you can purchase maximum 4 kg per year. Now 20 kg if you are a trust, then trust can purchase maximum 20 kg. Okay, and what is the the period of the sovereign gold bond is 8 years. The expiry is 8 years. What is the rate of interest you are getting? You are getting 2.5% rate of interest as an interest you are getting, and that is payable on a half yearly basis. Okay, and how the redemption will be done? Redemption means on maturity you will get your money returned. So on a market price of the gold, on a previous 3 days average will be calculated. For example, you have purchased a gold of say 5 gram and you have purchased it at 5,000 rupees per gram. So after 8 years you are going to mature your bond and you want money. So 5 gram will be taken, right? You have invested 5 gram, so 5 gram will be taken. So previous 3 days price will be taken. So for example, it is 5100, it is 500, or it is 5200. Average will be calculated, and that average price multiplied by 5 gram for a previous 3 day, that amount will be given to you. Okay, this is how the redemption of the SGB work. Now some full form you should remember here, that is FBIL stands for the Financial Benchmark India Limited. FIMMDA, that is a fixed income money market and a derivative association of India. I have already told you that full form you should remember. Then what is the FEDI? FEDI is the Foreign Exchange Dealers Association. FEDI is Foreign Exchange Dealers Association. Okay, this that generally gives some rules about what? About the forex transaction. What is forex? When you are dealing in the different currency, you are dealing in the dollar, you are dealing in the rupee simultaneously, then you are working in the forex simply. And IBA is Indian Banks Association. You are very much familiar about the IBA. Now this is some institution full form you should remember. Okay, now what is the forex market? See, forex market is you in India you are doing import export. So you are importing something from USA, you are exporting something to USA. So you are in India, you are dealing some transaction with the USA, right? So basically you are involved the cross border activity or the business cross border. So obviously the people in India will receive dollar and you have to pay some dollar. So you need to deal in the different currencies, right? So when multiple currencies involved, we are talking about the forex market, that is foreign exchange. Okay, now here we are having a different terms here. Forward contract means what? You are agree that after 3 months you will purchase the say a dollar at rupees of 71 rupees, you will purchase a $300. Okay, so when after 3 months, that is a forward contract. Then option means what? you agreed that after 3 months you will purchase a dollar at rupees 70. You will purchase a dollar at 71 rupees, and quantity will be $300. Okay, so but you have option, means you have option to purchase after 3 months. If you say that I don't have money, and after 3 months you can deny, because you are having option to write, option you can buy, option you can sell, option you can buy, option you cannot buy. You have option. It option is basically the forward contract, but you are getting right whether you should exercise it or not exercise. Now next is the swap. Swap means what? Simply swapping means what? See, if you purchase a dollar in the USA market, and you are purchasing dollar, and you are selling the same in, say, a Russian market. Okay, you are purchasing at a less price, you are selling at a high price, so you are swapping the currency. You are doing earning some money simply by the way of swapping. Okay, that is the simple swap. Now what is the future? So futures are also the derivative in the forex, which are very having similar characteristics, but only difference is that futures are only exchange traded. It is not over the counter traded. Exchange traded means what? For a futures are more safe. You have to if you have to enter in the future contracts, it are exchange traded, means they are having some rules and regulation. So basically the detail of that term we have to discuss in the upcoming chapters, and apart from that in the accounts also we have to discuss. And in a CAIIB we are having complete module on the forex. Okay, so you don't need to worry, you just understand the basic of forex. What is the forex? Okay, this is just overview chapter. Okay, now next is the capital market. What is the capital market? See, when you purchase some shares, when you sell some share, okay, so that money will go to this particular company, and that is nothing but the that will be used as a capital of the company, and that is basically the capital market. Okay, so capital market is where individual or the firm borrow fund using share, bonds, debenture, debt instruments, etc. The most common example is stock exchange like Nasdaq, NASDAQ, trading share from different company amongst the investor, share, debenture, mutual fund, unit. These are the best example for the capital market. Now what is the capital market? Basically when you purchase a share, you have purchased a share of Infosys, you have purchased a share of a Tata, so that share you are purchasing, selling, these are the part of the capital market. Simply remember that only. Now you are very much familiar who are the regulator in the financial market. We are having RBI, the banking regulator. We are having SEBI, the capital market regulator, and we are having PFRDA, that is pension fund regulatory, that is for the pension regulation. Now what is RBI? RBI is a central banking authority, that is the highest banking authority, bankers bank. It regulates the money expansion, means what? Inflation, indirectly or directly, inflation is being controlled by RBI. How? By the way of CRR, and by the way of by the way of the CRR also help to counter the inflation, but mainly two policy rates, that is a repo and a reverse repo, counter the inflation. Apart from that, RBI do the supervision of banking. RBI also act as the management to the government debt, means what? See, T-bills, how it is issued? It is issued by RBI on behalf of government. So government debt is being managed by RBI. It is a banker to the government. So government need some loan, they will go with the they will ask for the RBI to issue some T-bills or different bonds. Then lender to the banks, if any bank need money, they will go to RBI and RBI will lend them money. Then money market regulations. So RBI has also responsible for to regulate the money market. Okay, what is money market? We already discussed. These are some functions of the RBI. Now what is SEBI? SEBI is simply capital market regulator. We have discussed who is the capital market regulator. SEBI is the capital market regulator. So you have to remember that SEBI is the capital market regulator. Apart from that, as a regulator, SEBI does the supervision of what? Brokers, investment banker, stock exchanges, then financial institutions or mutual fund, listed company, all are them. Basically the SEBI is doing supervision of them. What is broker? You are opening your account, your demat account. right? With whom? With say grow, right? You're opening with Zerodha, right? You are opening with a Sher Khan. These are the brokers. Okay, they will charge some fee for the purchase and sale of the shares. Okay, so this is you are very much familiar with that, right? So simply remember here, only thing you have to remember that SEBI is the capital market regulator. Okay, now when we talk about the IRDA or the PFRDA, IRDA stands for the Insurance Regulatory and Development Authority, whereas PFRDA stands for Pension Fund Regulatory and Development Authority. So obviously it is very simple. IRDA will regulate the insurance business and the PFRDA will regulate the pension fund business. Okay, so it is very easy, you can just go through it. Okay, simply, who is the insurance business regulator? IRDA. Okay, IRDA. Now how the RBI work? How RBI worked? See, RBI is having mainly one important function, that is called as the monetary control. How RBI do the monetary control? By the way of a CRR or SLR or the repo and reverse repo. So in this way RBI can control the money in the market. CRR is, you know, CRR is the amount of cash that RBI, the every bank need to keep with the RBI. SLR is a statutory liquidity ratio. Amount of your NDTL need to be kept as a cash or a gold or some security with the RBI. And a repo is a repurchase option where in case of a repo is the rate at which RBI lent money to the bank, and a reverse repo is the rate at which RBI park banks money with the RBI. Okay, simply reverse. So this is all the tools that being used as a monetary control. So we are going to discuss in detail CRR, SLR, repo, how they are going to work. Okay, this is just overview chapter. Now RBI also do the banking supervision. So all the bank in India are under the RBI. So first we should know what is a commercial bank. So you are working in the public sector bank, you may work in the SBI, all are the commercial bank. Commercial means you are having commercial view. Our motive is you should work up commercially, and our motive is to earn the money. That is basically the commercial, right? Now commercial bank include some public sector bank like a Union Bank, like some other bank, like say Bank of Baroda. Okay, these are the public sector bank. Some foreign banks are also there. Okay, these are also the commercial bank, and some private sector banks are also there, like ICICI, HDFC. These are the private sector banks. Some are new. These are the new generation private sector bank. Some are the some are the old generation private sector bank. What is old generation? These are the Karnataka Bank, like Federal Bank, right? Dhanalakshmi Bank. So these are the old generation private sector banks. So you should understand what is a commercial bank. These are the banks which are which their motive is to work commercially, to expand and to earn the money. Okay, so how the bank work? What is the banking? Banking is basically the bank accept the money or a deposit from the people. Okay, and the same bank give as a loan to the other peoples. So if you are giving accepting a deposit at a 6%, you are lending it to all as a loan at a 9%. So difference 3% is the profit for the bank. Okay, this is how the banks work. Now what do you mean by NBFC? You should remember that NBFC stands for non-banking financial company. So what is the difference between bank and NBFC? That is a doubt you might have. So here is the explanation for you. See, NBFC cannot accept the demand deposit. What is a demand deposit? The balance in the saving account or balance in the current account. Saving account or a current account, balance in the saving account, current account. When the person give check, you have to give the money. Okay, that is a demand, that is payable on a demand. So NBFC are not allowed to accept the deposit in the saving account and current account, where they can have a deposit only in the form of a term deposit, that is fixed deposit. For example, say for a 5 year, for 7 year, they can accept a fixed deposit, but they cannot accept as a saving account or the current account balance. Okay, that is the first difference you should understand. Now NBFC do not form a part of the payment and settlement system, as it is not having current account or saving account. How can they do the transaction by using the checks, right? So they are not a part of the payment and settlement. Next, whatever the the whatever the balance in the current account or saving account, if any bank goes bankrupt, then we are having insurance cover, that is called as the DICGC, that is a Deposit Insurance and Credit Guarantee Corporation cover. It is now recently enhanced up to the 5 lakh. So up to 5 lakh, every person's balance is safe in case of what? In case of a bank. But it is not safe in case of the NBFC, because NBFC don't have a DICGC cover. Okay. Now next is the what is the primary dealer. So primary dealer means they are registered with RBI, they are licensed to purchase and sell the government security. So primary dealer are basically, these are the dealer, they are purchasing and selling the securities. Okay, purchasing and selling of security is done by the dealer, that is called as the primary dealer. Why primary? Because they are allowed to participate in the primary market also, and they can sell it the same security in the secondary market. Primary market means what? Basically they are purchasing first time, that is primary market. Now there are some stand-alone primary dealers. So yes, you just go through it. ICICI Security is the primary dealer. Morgan Stanley India primary dealer. Then Nomura Fixed Income Security, PNB. So these are the stand-alone primary dealer. SBI DFHI, then STCI primary dealer, Goldman Sachs. So these are the primary dealers. Okay, they are working as a stand-alone basis. So stand-alone they can purchase and sell the security. Apart from that, in India we are having a developmental financial institution. Means what? We are having, for agriculture we are having NABARD. So they are mainly doing the work in the agriculture. We are having Exim Bank, they are looking for the import export businesses. We are having CDB, they are looking for the different manufacturing units. We are having NHB, that is National Housing Board, which are looking for the housing for all. Okay, here is the NHB. Okay, so for housing loans NHB is there. So for different segments we are having different developmental banks in India. Now when we talk about the cooperative bank, we are also having the cooperative banks. See, basically we are having the state cooperative banks. Every state generally have the lead bank, that is state cooperative bank. Total we are having around 31. You don't need to remember the figure. Okay, just for your better understanding. Now we are having a scheduled urban cooperative bank. What is scheduled? So basically those banks whose are included in 34th schedule of the RBI Act, whose name are listed in the 34th schedule of RBI Act, that are called as the scheduled commercial bank, and that bank has to keep some amount with RBI. That's why the scheduled commercial banks are more safe. These are more safe. That's why some cooperative banks are putting before their name scheduled bank. Schedule means they are in the RBI schedule, right, in the second schedule of RBI, 34th schedule, and these are more safe. Next, there are some non-scheduled urban cooperative banks also. Okay, now come back to cooperative banks. The urban cooperative bank are controlled by RBI as well as the state government. So there is an important bit you should remember. Who control the RBI, urban cooperative bank? Obviously RBI as well as the state government, respective state government. And other cooperative banks are generally controlled by NABARD and the state government. So who is the main controller? For cooperative bank, the state government is having more control, right? But for urban cooperative banks, the RBI is also one of the main controller. Okay, and some cooperative banks is controlled by the NABARD and state government. So you have to remember, for urban it is RBI plus state government. For normal cooperative bank it is the NABARD plus state government. Okay, in this you can remember. Okay, now there are some state cooperative banks. After that we are having some district central cooperative banks and urban cooperative banks. Okay, so you just remember how and which banks is being controlled. So this line you have to only remember. Okay, there are some functions apart from that which RBI do. So we have already discussed RBI act as a management of the government debt or the bankers to the government. Okay, so whatever the loan government is taking in the form of issuing the bonds, in the form of issuing the T-bills, that is basically managed by RBI. lender to last resort. So if any bank is needs some emergency money, okay, and no other bank is helping to that bank, so then that bank will approach to RBI. That is a leader. It is not leader, it should be lender to the last resort. So last option, that bank can go with the go to RBI and ask for money. Okay, next, payment and settlement system. So RBI is having the clearing houses for RTGS, NFT, etc. So RBI is now developing its own network also. Apart from that, RBI is dealing with the CRR and SLR. CRR means there is some fixed percentage, say for example 4% of NDTL, means net demand time liability. For example, if the liability of a bank, for example, I will say, if the bank is having 200 crores of a deposit, if CRR percentage is 4%, so obviously 8 CR that bank has to kept as a cash with the RBI. That is a CRR. And what is SLR? Simply it is 18%. Now percentage may vary, you can just check it. Okay, 18% means 36 crore has to be maintained in the form of SLR. It may be in the form of cash, it may be in the form of gold or the security. Okay, so a section you can remember, CRR should be kept under the section 42 of RBI Act, and SLR is as per the section 24 of the Banking Regulation Act. So you remember here two acts are different. First, for CRR we are having RBI Act, and for SLR it is as per the Banking Regulation Act. Now what is equity and debt market? So equity and debt market, just we have already discussed what is equity market and debt market. Debt market we have discussed, right? It is a fixed income market. It compromises of the corporate security like a bond, debenture. Okay, equity means what? Whatever the bonds or debenture you are purchasing, right? Shares, right? So these are part of equity. Many of these are quoted at stock exchanges and various intermediaries are. So to understand what is the equity and debt market, in that we are having different intermediary. We are having stock exchange. What is stock exchange? See, BSE is stock exchange, NSE is stock exchange, Nasdaq is stock exchange, right? So you are very much familiar. Now what is a registrar? Simply registrar is the which maintain the record of share or debenture. So who maintain the record? Registrar maintain the record. Now what is investment banker? They undertake activity like issue of a stock, then raising the fund, advisory services. These are performed by the investment bankers. Apart from that, we are having foreign institutional investor. So what are that? These are authorized by SEBI to invest in the Indian equity market. So they are foreign based company or the investor, they are investing in the Indian equity market. Very simple. Next is the depository. What is a depository? Depository means they hold a security in the demat form and they maintain account of the DPs. For example, say security are safeguarded at a particular place. This place is nothing but depository. Depository means where you can deposit. Where you can deposit, that is a depository. You can keep some documents in the locker. So locker is a depository for you. Similarly, if you purchase some shares, you sell some shares. Okay, for example, you are having the account, say NPS account. Who maintain that? NSDL, CSDL. Mainly NSDL maintain the NPS account. So we are having mainly two type of a depository where the record is being deposited. One is CSDL and another is NSDL. So CSDL stands for Central Depository Services Limited and NSDL is National Security Depository Limited. So these two full form you can remember because we are having only two depository mainly in India. Okay, apart from that we should discuss what they mean by mutual fund. So what is the mutual fund? You are very much familiar. They are subjected to risk, right? You are observing some advertisement about the mutual fund. So what is the mutual fund? See, you must be familiar with the SIP, right? You are investing in the mutual fund. What is the mutual fund basically? See, if you invest in the high risk, means what? If you invest in the high risk mutual fund, so whatever, say for example 10,000, so you have invested in the 10,000, so that money, that mutual fund will invest in the share market, in the shares of what? Of those company which are fluctuating highly and they are chances of giving high return. So high risk, you are investing in the high risk or a high return. Then there's then say the same money whatever you are investing, the mutual fund will invest in the shares. So mutual fund, so means what? If you don't have a knowledge, you go for the mutual fund. You invest in the mutual fund, the same money will be invested by that mutual fund in the shares or stocks of that company to earn the profit, because they are having knowledge. Okay, so what is mutual fund? Mutual fund is nothing but the simply entity which collect money from the different people, and that money will be invested into the shares. Because we don't have knowledge, so we simply go for the mutual fund. Mutual fund having different expertise, and depending on your need, they will invest in the shares of a different company. For example, if you need fixed growth, so they will go. So whatever the money you have invested in the mutual fund, that mutual fund will that invest that money into say Tata's share or the Reliance share. For long term they are giving good return. If you want more income in short period, so in the high risk they will involve, they will invest some company which are new to the market, and they have chances to grow suddenly or go in the rapidly. So this is basically the mutual fund. Okay, now what is the exchange of India? Exchanges of India means MCX we have to discuss. Mainly MCX is given in your Macmillan book. So MCX stands for multi commodity exchange. So MCX is the independent commodity exchange of India. It is independent. It is established in 2003 in Mumbai. It is who regulate it? Obviously the SEBI is the regulator. So SEBI is the regulatory framework of SEBI. MCX product, what a product it offer? It offer the future trading in various commodity. As it is a commodity exchange, it offer the trading in the commodity. So it is India's first listed exchange, commodity derivative exchange, that facilitate what it facilitate? It facilitate online trading of the commodity derivative transaction. It may have a future or an option. They are having base metal like aluminum, copper, zinc, lead, nickel. They are having energy. In energy, they are dealing in the crude oil and natural gas. For agriculture, they are having cardamom, cotton, palm oil, copse, and the rubber. Cotton, copse. Okay, so copse basically it is cotton. So so you don't need to worry about the MCX. There is a lot of things you can go through it, but as a part of they have given in your Macmillan book. So what is MCX? There is a multi commodity exchange. How they can ask you a question? Simply they will ask you which is the India's first independent commodity exchange. So it is MCX. Okay, in this way there will be a question. You don't need to worry. Okay, moreover if you want to go in detail, they can ask you the best metal. So best metal is aluminum, copper, zinc, lead, and nickel. So you remember that only. Okay, what are the base metal in the MCX? Okay, so this is the end of the chapter. So in book very limited information about the financial system is given, but here I have given a lot of information so that you will get a better idea about what is the Indian financial system. So here we will stop and end our first chapter. In the next chapter we will discuss the regulatory, that is how RBI regulate the Indian financial market.